to Trade.Set.Go. My name is Yiannis, and today we're going to be looking at CFDs. What do they stand for? What is all the hype about CFDs? Why does everyone want to trade them? Why is everyone using the leverage and how they're using it? In the next 15 minutes, you will have everything you need to know about CFD trading, and you will find out what you need to know to put your first trade in safely in order to start your trading career right now. So what are CFDs? You're going to find out what they are literally. What is the definition of a CFD? What does it look like in the real world, in the real markets? Why are they different from stocks, ETFs, and all these other assets that we as traders are exposed to and we can utilize? And why might CFD be one of the best solutions for new traders to get involved in trading? One of the biggest mistakes that you see in trading and in new traders is that they quickly open a brokerage account, they open a CFD account, and they jump into the markets and they start trading it without knowing what a CFD is and how you can make money trading a CFD and what the danger is of trading CFDs. By the end of the episode, you will be set up with everything you need to do things properly. So let's start with the definition. What is CFD? CFD stands for contract for difference. You trade the price movement, but not the asset. In other words, the CFD is an agreement between you and the broker to exchange the price difference of the asset between where you open a trade and you close one. You never, ever own the underlying asset, even if that is shares, oil, gold, and indexes. You only trade movement. You speculate in what the price will do, and you will make or lose money through the movement of price. Now, what can you trade with CFDs? You can trade every asset available. We're talking about Forex, commodities, crypto, stocks, individual stocks. There's more than 10,000 markets you are able to trade with CFDs. So I want to give you this analogy for you to understand how trading CFD is. Let's say someone is selling a house for $100,000 and you are betting on that price of the house going higher. If the evaluation of the price goes higher, then you would make that money difference on what you betted that would be. Let's say it's 130,000. Your valuation of the house has risen to 130,000. Your bet is now 30,000 in profit. However, if that valuation drops to 70,000, now you have lost 30,000 out of that bet. The house has never changed ownership, but you are losing money because you are betting on its price, not on the asset. So let's look at what that looks like practically. When you open the price at this level here, the price moved up all the way to the top here. Now, what happened is the mark moved in one direction and closed. The broker then pays you the difference of that price. If it goes against you, you pay the broker. So let's say the market moved 40 pips, times 10,000 units, you would be gaining $40 in either direction if you are long or short. And that is what is brilliant about CFD trading is you can speculate the price in both directions. You might be speculating that the price goes up, and if it does go up, you make money. If that price goes down and you're speculating that the price will be going down, you're still making the difference from the open to your close of your trade. In this case, it's gone up for 40 pips. You've made $40. You speculated short. You sell and you close your trade for profit for $40. Exactly the same way, the same amount of difference in price. One was going up, the other one is going down. One of the biggest hot topics with CFDs is leverage. And leverage is such an amazing tool, but it can be a detrimental tool to a lot of people that don't know how to use it. For instance, you may deposit into your account $500. And for this case, if you had a 30-to-1 typical retail CFD leverage, you are looking at buying power of $15,000. That means that you can trade like you had $15,000. So when 1% moves on your position, it's like it's moving 30% up or 30% down instead of the 1% when that leverage is being applied. That can be extremely useful when you're gaining the 30%, but it can be extremely harmful when you're losing that 30%. As you can see, leverage can be extremely dangerous if you don't know what you're doing. Now, we did a whole webinar on, so I have done a whole At Trade.Set.Go, we have a whole webinar on leverage and what is the appropriate leverage to use. And not only that, I actually give you a tool on how you can calculate your own leverage. Make sure you go watch that video because it's extremely useful when you're trying to identify how to use. And you can test your knowledge to see actually, do you know what leverage is and how you can utilize it? So let's get back to our get real moments. Leverage does not care about your confidence. A high leverage position that moves just 2% on your account on a 30-to-1 leverage, you can potentially wipe out 60% of your deposit in one trade. That is how seriously we have to take leverage. Now let's talk about a trade of a CFD. When you go into the market, you have 3 costs you have to be aware of. All three of these costs matter, and that's why your broker really matters when you are trading in your execution. One is the spread, which is the difference between your buy and sell, the bid and the ask that you hear in trading. Obviously, as a trader, you want to have the spreads as small as possible. And the closer they are to zero, that means that when you're pressing the button, you are getting exactly the same price that you want. So one key thing about spreads is you want to keep them as small as possible. So that's one thing that you need to look at your brokerage. How small is the spreads on the assets you're trading? The next thing that you need to be aware of is the commission. So a broker might be charging you a commission to enter and exit trades. At Trade.Set.Go, this only applies for shares and crypto. Everything else trades commission free. So that means Forex, indices, commodities, and ETFs. But you have to be aware of the commission. So every time you enter, if you're seeing a $4, a $5 application for you to enter or exit a trade, then you know that that is the commission of the trade. Finally, and a lot of people overlook this when they're trading, is the overnight fees. If you are not careful with your overnight fees and you're holding trades in multiple trades, or you're swing trading and you're not aware of your cost, you might be receiving so many fees that your trade doesn't make sense to hold. And it might be a case that you can close it, or it might be a case that you need to manage the trade better. These are the 3 costs that you need to be aware when you're trading CFDs. So now let's look a little bit about the assets that you can trade with CFDs. CFDs, like we said, is amazing because you can trade over 10,000 plus markets. And we're talking about Forex, indices, commodities, stocks, and crypto. In this case, if you're starting new with trading, I would recommend to someone to start with Forex for multiple reasons. Forex, obviously, we're talking about currencies like the euro dollar, your pound dollar, USD JPY. And there's a reason for that. It's one of the biggest global markets. It's very liquid, and it's very cheap to get involved. That means you're getting really good tight spreads. You're getting deep liquidity. You can be trading one market, such as the major market of a pound USD or a euro USD, and you will have really good setups once or twice in a day that you can trade with. You can also trade these assets with very minimal margin, which means that you don't need a massive deposit to enter for Forex. Now let's move on to indices. Indices, the markets get a little bit bigger. So for instance, if we look at the S&P 500, means that it's taking the 500 best companies in the US and they pile it in an index, and you're trading that indice. This is where a trader needs to have a little bit more macro knowledge about trading. He needs to understand, if it's the S&P, for instance, what is happening with the US markets, how is that affecting the markets, the stock market specifically. You need to be more involved when it comes to your decision making. And I think it's a very good transition from the beginner. Forex to indices is a natural transition just because you're not trading a single stock, you're trading multiple stocks together. Then we have commodities. Commodities normally is known as the trend following. As you can see now on that massive bull run that we've been on gold, you have oil, natural gas, all these things that are global movers around the economies. They tend to lean towards trends just because that is how the economy works. Finally, let's talk about stocks. For stock trading, you're also looking at being more involved in understanding companies such as Apple, Tesla, Nvidia. Why would I want to invest in one of these? If you look around on your desk and you have 10 products of Apple, does it make sense for you to buy Apple for the long term? Or if you heard news on Tesla, on Nvidia, or you have an IPO coming now, like we've heard about SpaceX, do you want to day trade it, and do you want to make money within those movements around news? And we haven't even touched crypto. As you can see, the global market, you have so many opportunities. If you're starting today, don't get overwhelmed. I would say focus on Forex, specifically 1 or 2 major pairs to get you used to the markets, because Forex can move in one direction, but it will always oscillate towards the mean. So you have an opportunity for you to get a feeling and understanding that is not as aggressive as indices, stocks, crypto, and commodities. Now, this is a big one because a lot of people say the first thing to do is open a demo account. I never did that route. I always opened a real account. The reason is because I come from elite sport, and now in sport, you have all these classes with simulations of playing the sport and doing the actions and shooting in different areas and practicing skills that you will do in the real world. For me personally, and the athletes that I worked with, it never really worked because you never get the feel and the understanding of the physiology, the exposure they get from the real deal. So that's why I always recommend to anyone who's starting with trading, even if it's $100 to $200, open a real account, because you will get the real account from the get-go. Will you be able to trade big size? No. But will you be able to trade the real markets and understand how trading works and how you can improve and see what your weaknesses are on this early stages of your career? It definitely does. And the biggest thing that comes with trading is the emotional baggage. And that emotional baggage can only be reality when you're trading something that hurts when you lose it. And for you to lose something that hurts, it has to be real money. If I went back to start trading today, this is what advice I would give myself. First, start with the real deal. Start with a small account, small size your risk small, just because it would give you a long run to learn. And always put money that you can afford to lose. I wouldn't want to be, if I have 2,000 in my bank account, I wouldn't want to put all my 2,000 into that account. I would want to put $200 to $500, almost like a learning fee for me to expose myself on how I can trade CFDs to make money. $500 you can trade micro lots. The goal is here to get experience and get exposed into the markets and see how your body behaves when you're in drawdown, when you're in profit, when you are over trading. All these things that are natural behaviors within the first stages of a trading career. I would definitely also recommend to have a fixed risk per trade. So risk no more than 1% to 2%. That means on a $200 account, that is $2 to $4 per trade. That sounds very small, but it will keep you in the game and you will get so much learning exposure. It will be worth it when you're trading for $500 and $1,000 of dollars down the line. And this is the most key part of the whole loop, is for you to journal every single trade every single day. Not only what you executed, but how you behaved around trading, because behavior in trading is the key to success. You need to know how your body reacts to drawdowns, like we said. In data science, we know that to make meaningful information, you need more than 30 data points. So make sure you have a journal of more than 30 attempts of going into market, executing, and seeing the result for you to get meaningful information back. Now, after 30 trades, when you've gone into market, you've seen your strategies, you've seen everything working, now you're in a position to see, have you developed a strategy that is actually profitable? Then we can start thinking of scaling the account a little bit bigger. So make sure you take a screenshot or a photo of this slide. And these are the 5 questions that you need to ask every time before you go into trading. What is my direction? Am I going long and am I going short? And why does the chart support this thesis? Where is my stop loss? If I'm risking 1% to 2%, that needs to be fixed for that trade. I need to put that stop 1% away from where I am trading. When that stop is in place, I don't move it. That is it. What is my target? Am I aiming for 1 to 2? Or have I got a great setup that I want to get a little bit out of it more? Make sure you predetermine these factors in the trade in order to manage it appropriately and to be able to look back in order to analyze what went well and what went bad in every single trade. Fourth question is, what am I risking? And this is one of the most important questions. I don't want to risk more than 1 to 2% on my account in any single trade. That needs to be set in stone. I'm not moving from 1%, adding positions, and then going to 3 to 4%, and suddenly the account is blown because I've learned nothing. And if I've learned anything, I've learned a behavior that is going to hurt a lot more when I'm dealing with a 100,000 account or 200,000 account. And finally, am I in the right state? Now, you might have seen my NLP video, which is on psychology. Make sure you go and watch it if you haven't. This is all about the state of mind. We need to record, was I calm during trading? Was I getting the itchy fingers to add another position? Was I anxious? Was I too excited? All this information can feed in to the physiology part of our trading, which is another big group that we need to attend to if we are to be successful in this industry in the long run. So this is a question that I always had. Could someone tell me what are the main mistakes that beginner traders do so I can avoid them, so I can fast track my learning? And here they are. I'm going to give you the 5 most common mistakes that traders do when they get involved with CFD trading. First, opening a live account too soon. And what I mean by a live account is opening an account that actually matters to your finances. They've saved up for 10 years, they've got a big buffer. They put 10,000 into an account and they start trading it without knowing what they're doing. That is a big, big no-no. You don't want to go into an environment that you have no clear plan. The worst thing that's going to happen is you're going to blow that account. Best case scenario, you're going to lose way too much of that account, which you could be using to scale up after the original 30 to 50 trades that we talked about when you're opening that small account to get going. Secondly, the biggest mistake is trading without stop loss. Sometimes adding a stop loss and moving the stop loss all the time. And what traders will always say is that I'll be on the screens, I'll watch it, I will manage it live. But the reality is that you are not managing that trade. Your emotions and your psychology and your nervous system is managing that trade. So you need to have that stop in place and not move it until the end of that trade. Now at Trade.Set.Go, we can go up to 400 leverage. Now that is a big amount of access that traders have for their trading. Now, the biggest mistake of beginners, and you don't see in elite traders, is they will utilize all that leverage to try and make money fast. No one has succeeded in that game. Anyone who has used leverage to increase the speed of when they become successful has always been a failure. Number 4, ignoring the overnight fees, holding those trades for multiple weeks, and suddenly seeing the difference from your live P&L to what your cost is, and realizing that you're now, even if you're in profit, the fees are more than what you're making, and you would need to close that for a loss. So making sure that you are taking into consideration those overnight fees within your trading. And finally, one of the 5th and one of the most important one is when you've traded, you've had a bad day, the eagerness to get that money back, to go and get it back to the market because it took your money away. That ego-driven behavior is always there, trying to regain what was lost. That is a recipe to failure. And I'm here to tell you the best way to avoid that is to close your laptop down. Go and do something else. You have executed your plan. Your execution was wrong. That is part of the journey. We don't need to correct it within the first 5 minutes of trading on the next hour. You leave, come back tomorrow, look at the market fresh, and you will have all that knowledge that came from that loss. Now, if there's one golden rule when you're starting with trading, if we want to call it the antidote, I generally believe that risking just 1% on an account is small enough that it will make you survive long enough to see your mistakes. And when you see your mistakes, you will be able to adapt and improve and fast track your learning than anyone else who's increasing that percentage as they are starting to trade. So now let's talk about a timeline, because everyone says, I want to start trading, CFD brokerage, I've got all this leverage I want to use, I want to learn, I'm eager. What would it take? How long will it take to be profitable and actually start seeing trading becoming the real deal where you're making money out of it? One of the best recommendations that I have was to take things slow. And I think that is where prop firms are great with this, because they give you a challenge that you can pass and you can take your time. With a live account in a CFD broker like Trade.Set.Go, I would suggest giving yourself room for 60 to 90 days of learning. That's when you will be able to trade for 30 to 50 trades. You will be able to collect your data, look at what's working, do your journaling, and then be in a position 3 to 6 months down the line where you can say, I can now be confident that I can apply more capital towards this business. So if you want to break it down 1 to 6+ months, as you can see, opening a real account with a small deposit is our first month. In that second month, we will be able to look at 50 trades logged and fully journaled, micro lot sizing, building your checklist, identifying your most consistent setups and strategies that you're using. On that third month, that's when we can start looking at the data and see if it's actually worth it of adding more of our capital into our trading. Then when we have 4 to 5 and 6 months of proof, half a year, it might sound like a lot of time, but how many things have you done in your life where you've only had 6-month exposure to it and you've done well? That's what we're trying to achieve with trading. Give yourself time to achieve, and the achievements will come on year 1, year 2, year 3, year 4. This is the marathon. We don't treat it like a sprint. So there we go. We have all the information now. How can I go step by step to entering my first trade? Obviously, we need a CFD brokerage, which gives you access to CFD assets and also the leverage. Choose your market. It might be, like we said, if you're a beginner, looking at a macro currency such as euro dollar or pound dollar, then identifying what setup are you going to be using. Am I going to be trading the 1 hour, the 15 minutes, or the 5 minutes? What is that looking like in terms of indicators and strategies? Having the rule around your stop. I'm going to be fixing my stop to 1% and it's going to be placed there and I'm not going to be moving it. Setting your target. Will it be 1 to 1 to 2, 1 to 1.5? And finally, clicking the buy button, or if it's a pending order, waiting for the pending order to be filled to enter the trade. And the last part is journaling. That is your whole step-by-step guide of getting your CFD trade in place. And you're going to do this 30 to 50 times before you start thinking of scaling the account to a bigger size. So if you can remember nothing of this video, remember this. You trade the price movement. You're never trading the asset. You're never owning the asset. You're going long or short. So you're getting paid by the difference of price in movement. Leverage is a great tool, but it amplifies everything. A 1% rule is a must when it comes to keeping your account safe. 3, start real. Start with a small account so you get the real deal. You get the real emotions. You get to participate in the real world before you even start thinking of scaling anything up. So if you've enjoyed this episode, make sure you subscribe and join our Discord as well in the description. So in the next episode, we're going to be talking about charts. We're going to be looking at price action. We're going to be looking at support and resistance. How can I draw them on? What is the market structure? And what setups are actually worth your risk when it comes to those 30 to 50 trades? So make sure you subscribe and like, and I'll see you on the next one.